Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we talked about the XLE. That is the ETF that tracks the energy sector. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we talked about the XLE. Specifically, we talked about buying a deep in the money call option as an alternative to actually buying 100 shares of the stock outright. We're using the strategy to try to limit our risk on the downside, but still gives us some substantial upside if we do see the energy sector pick up going into the end of the summer here. So I'm highlighting the strategy in the options playbook. It's under the rookies corner, and we have it highlighted as buying a Leaps call as a stock substitute. Now, Leaps is just a fancy term that the Chicago Board Option Exchange came up with. It stands for long-term equity anticipation securities. All it means is a longer dated option contract. There's really no difference between the two. Now, in this strategy, as opposed to just saying we bought a call option, one of the things that we focused on and is mentioned inside the options playbook is that if we're doing this as a stock substitute, we want that underlying option contract to act a lot like the stock. How do we determine that? We look at the delta. Specifically, we're usually looking for options that have a delta around 0.80, or that would mean that if the stock went up one, your option contract would move up about 80 cents. Another way to say it is you'd get about 80% of the stock price movement. Overall, bottom line is we're going to pay for it. We're going to pay for this option contract. There's some money that's involved in it, and we're going to pay a decent amount, but it's a lot less than buying the stock outright and hope that the underlying stock goes up. So let's see what happened with the XLE this week. This is a 15-minute chart. We're going back to Tuesday. We always tape the stock play of the day. It's always noon. It's always live using live markets. And so this is noon on Tuesday, the 29th. We see that during the stock play of the day, we had a little bit of a dip down and then it came all the way back up. So some volatility during the show. But what we look to do, what actually ended up happening as we got into the end of the week is market came down, closed a little bit down on Tuesday, actually had a decent up day on Wednesday, then a real good update on Thursday, and now we're kind of giving back a little bit of the gain. So we're in this position for the long haul. We got 170 plus some odd day option contract. We went out to the December 17th expiration. Okay, so I think it was like 171 days out when we looked at the trade. So we're in it for the long haul. So what can we do? We got the market's gone up. That's a good thing. That's the direction that we want it to go. So bottom line is we're just going to really stay the course. But I'm going to give you a couple ideas as to what you might want to do with this position while you're waiting for the underlying to continue on up, hopefully, obviously. But as always, whenever we talk about these trades, they're not meant to be a recommendation. The biggest thing is trying to figure out, okay, if we have a forecast on an underlying, and you can apply this to your own forecast, what is a strategy inside the options playbook that I can use to benefit if my forecast is correct? And in this situation, we're also minimizing our risk. The energy sector has had a real strong move since the beginning of the year. So a lot of people think it's a little bit frothy. Part of the reason why we're going to use the options to reduce the risk on the downside. So let's look at the option chain and let's see what's going on with XLE right now. All right, XLE right now is at 54.49. It's down about 32 cents. So we're up about 75 cents since we put on the trade. If I scroll down, this is the expiration that we were looking at, the December 17th expiration, now 168 days out. We bought the 47 strike. The delta was, I think, at 78 at the time, and right now we see it at 80. I click this little buy button and put it down in the strategy box, and I'm going to highlight that we're on the call side of the Ally Invest option chain. So now it's down in the strategy workbench. This was the trade that we were looking to put on. Depending on, like I said, the market actually moved a little bit down or in the middle of the call. So you could have paid anywhere from $8 to $8.15. We'll highlight the ask and we'll say that we paid $8.15 for that trade. We now see the midpoint trading at $8.75. So we're up a little bit. And that's relative. Honestly, if you just think about, well, the stock went up about 75 cents. This moved up about, 50 cents. So we got a good part of that actual stock price movement overall. And why? Because we went in the money, we paid for the option contract, and we got some delta. So $8 and some change, that's about 15% of the stock price, which means we would have bought 100 shares of stock on a $54 stock. That's about $5,400. That would have been your capital that you would have had to put up to buy 100 shares of stock. We said we want representation, but we don't want to pay all that money. So we went in and we paid $8 and some change, and that would have been about 800 and some odd dollars plus commission. We limited our risk to that $800 or 15% overall, but we also came up with a plan. We said, all right, on the upside, we're going to be okay, not too worried about when we're going to sell it. We're going to try to ride it throughout the summer, hoping that oil actually can get up above $80 a barrel. That would be real good news for the energy stocks overall. It hasn't been that high in many years. And on the downside, though, we said, okay, here's the underlying stock. This is where it's at today. This profit and loss graph is actually highlighting the trade that we have on right now. In other words, it's as if we bought that in the money call option right now. Now, what I want to highlight is that if we are wrong about our forecast and the market goes down to our short strike, which is at the 47 level, right where this pivot happens at expiration, you see how the time value helps us if we are wrong on our forecast. And that if the market comes down and it gets to our short strike or our long strike, I'm sorry, we would just want to sell it. Just get out of the position. Use that as your stopping point. Take advantage of the fact that it's an at the money option contract. And that's where a lot of time premium, a lot of juice actually settles into the option contract. So as expiration approaches, obviously this line will eventually morph into the dotted line. So we have 168 days in here. Let's go all the way down to 5 days remaining to expiration, and we'll regraph it. And now you see it looks a little bit more like the profit and loss graph at expiration. So moral to the story is here, this time value that we're buying, the fact we're going out further in time, really helps us if we're incorrect on our forecast. But if we go back to 168 days and you say you're correct on the upside, one thing that's really nice about Delta is on the upside, it doesn't hurt us as much in that it protects. On the way down, Delta gets smaller, it decelerates. On the way up, it accelerates. And ultimately, the delta would go towards 1, meaning that it would be just like owning the stock. For every point that it goes up, you're going to gain 1 point in your option contract. And that's highlighted by the fact that the green line eventually, as the market goes up, morphs into the dotted line, hinting that the delta is approaching 1 and we're getting 1-to-1 movement with the underlying stock. And it doesn't take that much, right? Because we're right here. So we go up a couple of points, we get to 60, 62 or so. A lot of that time premium comes out, the delta goes to 1, and we get that acceleration to the upside. So that's why I build this as a FOMO trade, fear of missing out. And that XLE has made a big run up since the beginning of this year. And because of that, markets might be a little frothy. How do we protect ourselves, but then still have a position in just in case it continues to go on up? We go out, we buy a deeper in the money leap option. And specifically on the XLE, one of the biggest things that, and I highlighted this on the show on Tuesday, is that the options are very liquid in the XLE. So the longer term options have decent markets. You can get filled at a decent price overall when you're working an order in the XLE. And sometimes that's an issue on underlyings that aren't as liquid, don't trade as many shares of stock as the XLE does overall. Okay, so I'm getting a little long-winded, but I also want to say, okay, at any point in time, whenever we do these FOMO trades, buying deep in the money option contracts, an alternative is actually to turn it into a fig leaf. And as with covered calls, which the fig leaf is a derivative of, we actually call it the leveraged covered call is actually another name for the fig leaf. But most people will usually buy the stock. Stock goes up on a covered call and then eventually sell a call and be okay with that. So in this instance, we had the stock go up a little bit. You want to sell a call against the position, that's fine. But we call it a fig leaf because you're kind of covered, right? We got something that looks like the stock, but we don't own the stock. So if you get assigned on that short-term option, you're going to have to do something because you don't own the stock. You either got to exercise your long option contract or you got to sell it and go buy the stock. So it's important that if you do this strategy, and here's how it would play out, go back to the option chains, um, to go shorter term and probably not bring in as much premium because you really don't want to be assigned. So if I had the underlying stock, I might sell the 55 strike call, but because I don't, I'm going to sell the 56 or maybe even the 57. Let's see where the 57 is at. Give myself another strike here, scroll up a little bit. So the 57 strike is 30 cents. So I'm somewhere between here, 57 and 56. Maybe you split the difference and you sell this oddball 50-cent strike, 56 and a half. But if I'm doing this, ultimately, I want to try to capture the time premium that I still have to pay for the option contract. It's still an option contract. I still have time premium. So I'd think about selling maybe the 57 strike call. I want to try to avoid the assignment. I'm 14 days out. I am hoping that the stock doesn't get to 57, but if it does, I'm going to be up on the position. I can just close it out or I can roll it. And there is a section in the options playbook called rolling, how to roll a covered call. So I'd make that required reading if you decided to do the fig leaf, but you are covered on that position. And this is the way the trade would then look. You would be long the 47 strike call going all the way out to December 15th. And then you would be short the July 16th strike call. So how much time premium do we want to whittle away? Well, if we just look at the actual call option right now with the market at, we'll call it 875 or so, right? The 47 strike. If you just take a peek at the put, it gives you a hint as to how much time premium. It's not always an exact number, but that's all time decay. That's all time premium because that on the put side is out of the money. So I'd really like to try to sell enough calls to capture about $1.50 worth of time premium. I'll just whittle away at it. And I'm going to avoid situations where OPEC might be talking. I don't know if I want to be in a call position at that point in time, or we get into earnings season and all the energy companies are announcing earnings. So I'm going to avoid those times, but that's not what's going on right now. It's July, right? The earnings season is around the corner, but it's not here yet. So I would think about maybe selling that one call against that position, and that would be okay. That's an alternative that you could do. Not saying that you have to, but it's an alternative. And that's what stock play of the day overtime is all about. So that's going to be it for this edition of the Stock Play of the Day Overtime. Please click subscribe, ring the bell, and we will be back this Tuesday for the next Stock Play of the Day. The markets are closed on Monday. Don't forget that. But we will be here this Tuesday. Have a great 4th of July weekend. Thanks for coming, everyone.